Jamie, just to kick it off, why don't you tell us a little bit about your background, how you got into the industry, and where you're at today?
Sure. Well, thanks very much for having me on. I am a native of Seattle, Washington, here in the Pacific Northwest, although I live now here in Portland, where I've been for a number of years. After graduating from college, I entered the banking community. That's been my entire career for, I guess, 30 years now. I spent kind of my early banking years in retail banking and then kind of graduating to small business and commercial banking, all really in lending. That's been my entire career. So working with kind of small business, middle market sized businesses, helping them with all sorts of different forms of credit over the years. And so that's been my entire career. Something I just really observed and appreciated over the years was kind of a segment of businesses that needed access to capital that just kind of resided on the edges of what banks like to do. And these were businesses that, in my opinion, were credit worthy, but for whatever reason, just kind of sat outside the bank's credit criteria or pricing criteria. But I felt were good loans to be made. And I just saw enough of these over the years that finally, a couple of years ago, I did something about it. And I formed a fund with a couple other partners where we do exactly that, which is lending to small businesses looking for additional access to capital that maybe sit outside of what banks typically like to do, and helping them grow through working capital or acquisition financing.
So tell us a little bit about the companies and um, kind of a follow-up question. We could do it separately, but what do the banks think about these companies? Why don't the banks like to make these type of loans?
Yeah, that's a good, two great questions. So, kind of first of all, who is our borrower? So, we do all commercial loans. We don't do commercial real estate loans, although we might take real estate as collateral. So the businesses we work with are all operating entities. So to kind of paint the picture a little bit more, these are, first of all, not startup, pre-profit, pre-revenue companies. These are ones that are already profitable or at least cash flow or EBITDA positive, and they're looking really to throw some gas on the fire and really accelerate their growth through either permanent working capital or to help with acquisitions. And that's kind of where we step in. From an industry perspective, we're pretty broad based. We don't do things like cryptocurrency or bioscience, cannabis, adult entertainment, kind of the usual types of companies that are kind of tough for us. The companies we do like really fall under one of two buckets. First, it's companies that make stuff. So think manufacturer, wholesale, distribution companies, both B2B and B2C. And then we work with some service providers as well. So I talked to someone recently that was looking to acquire a trucking company or maybe an excavating company, so things like that. Geographically, we work with companies really all over the United States, although we have a tendency to focus on the Pacific Northwest, which is where I live. And the kinds of loans we do, and we do lending really 500,000 to 5 million is kind of our sweet spot. There's other private credit funds who do what we do, but most of which kind of start where we leave off. So we don't have a real kind of busy market for the kinds of loans under 5 million that we focus on. So why do banks not want to do these loans? Usually there's a story to be told. And our underwriting includes more than just looking at pieces of paper and financial statements, although that is a part of it. So, we're willing to do a deeper dive with some of these businesses than a bank might feel comfortable doing. We're willing to get creative around structure. And we often run into businesses that have maybe either kind of maxed out their bank or their bank has maxed out them, and they're just looking for a little bit more. And that's where we tend to do best.
That's great. And I guess maybe talk to us about the underwriting process. What does it look like? The time it takes to go through this process with potential clients, and then just maybe also as a separate segment to that, has that process changed over time in your view from your career when you started where it's at now? I'd love to hear that as well.
Yeah, so I would maybe answer the second question first, which is really my process has not changed much over the years. And as much as I don't, I think this is an overused word, I would say that we take a very holistic approach to credit analysis and credit underwriting, which is kind of two part. There's an art and a science for sure. So the science is looking at financial statements and having discussions with the borrower around their supply chain, client concentrations, historical performance, what the future looks like, what their defensible position in the marketplace is, kind of all traditional credit analysis. But then the art of this is really kind of being on site, walking the machine shop floor with the owners, talking to the management team, being able to, as I learned a long time ago, kind of stare into the whites of someone's eyes and just know if they're going to pay you back or not. And that's hard to do by looking at a piece of paper. And so we kind of combine those things. Frankly, that's been part of my underwriting philosophy since I started my career. And knock on wood, so far that's worked out well for me, and I think that translates well into our company today.
That's great. Um, from a middle market perspective, just seeing the deals that come your way, maybe if going back from last year, 2023 to now, has that increased, say the same? Just curious where the opportunity set lies for you as you move forward.
Yeah, so we basically have a line out the door in terms of people who want to borrow, for better or for worse. And I think the reason for that, there's multiple reasons for that. And I would maybe start by kind of what's going on in commercial lending in general. And I started my banking career in 1995. I think I've gone through four recessions during that period of time. So I have, at least some exposure to what happens during these cycles. And what's very common is when there's a concern around economic conditions or recession, large banks get more conservative. This is not a surprise. This is very normal. Typically, what happens though is that smaller banks, so think like regional banks, community banks, they pick up the slack, and that's why they're there. That's what these smaller banks are kind of designed for. But what's happened in this cycle that's different than past ones, that at least I've experienced, is this liquidity and capital constraints. So, last year two banks failed, or at least two banks failed, but I'm thinking about Silicon Valley Bank and First Republic. These did not fail for credit quality reasons. This is my opinion, of course. And that's the number one reason why banks failed. They failed because of liquidity management issues. And so what I've seen, and this is now a very broad statement, but what I'm seeing is kind of a flight to safety for retail and commercial depositors. So large banks are growing in deposits, but not lending as much. So you can kind of see where I'm going with this. And so smaller banks, even though they may want to be lending, have their own capital issues. So they may be able to support their existing borrowers, but maybe are struggling to take on new ones. And then kind of the third phenomenon I throw on top of that is COVID, which statistically was a boom for new business formation. So, think kind of great resignation, things like this. And while not all these businesses are successful, some are. 3 years later now, they're seeking capital. And so where do they go? So when you kind of put all this together, and frankly, the fact that we do lending kind of below the minimums for most other private lenders, you know, we're busy for sure. And for better or for worse, I get a call pretty much every day. Now, not all these are credit worthy, but many are. And at the end of the day, we try to do like one or two loans a month. So we say no more than I would like to, but that's kind of the nature um, of the business. And it just underscores, in my opinion, the importance of private credit, which is frankly a growingly more important part of kind of the commercial lending ecosystem these days.
Absolutely. Tell us a little bit about how these companies are finding you. How do you get connected with, all these different companies in this space? How do they, they need money? How do they come across, somebody like yourself?
Yeah, so for better or for worse, I've been in commercial lending for a long time and in the Northwest a long time. So most companies find us. We get referrals from other commercial banks, which we're very much a complement to, not a competitor to. We get referrals from investment bankers who are putting together transactions where there's maybe, one more slice of that capital stack that's needed to complete a transaction. We get loans from other kind of venture debt and mezzanine private lenders who run into things that might be too small for them. And we're super proud that we are getting more referrals from existing or former borrowers of ours who have had a good experience. We help them solve a problem, take advantage of an opportunity, and now they talk to other entrepreneurs who are finding their way to us.
That's great. It's good to have that flow of activity coming your way.
Well, absolutely. I've been doing lending for a really long time, so I've kind of maybe not seen it all, but seen a lot. And I'm happy to be a resource for these entrepreneurs. I mean, it's a leap of faith to go into business, and you're taking a huge risk by doing that. And I believe firmly in kind of supporting the entrepreneurial spirit, and lending is kind of the way I've chosen to do that. But frankly, if I can help in other ways and point them to other resources that they can take advantage of, even if I can't do alone, I'm happy to talk to these people.
Yeah, it makes sense. Obviously, the big challenges for any small business is undercapitalization, right? If you can support that and provide that vehicle. I'm curious too, just from a term perspective, is shorter term loans, longer term, where do you guys stack up in that equation?
Yeah, so we tend to be really more of a bridge type purpose. I mean, we're pretty opportunistic, meaning, so first of all, we're not here to save a company that's struggling or failing. That's not what we
Right.
do. We help companies take advantage of market conditions and accelerate growth. So we try to stay pretty short. The average loan on our books today is about $1.5 million. The average duration of our loans are probably about 18 months, give or take a couple. So we do underwrite our loans to recurring cash flow in terms of how we get paid. But in reality, we typically get paid via one of three events, with an event being either a more traditional lender refinances the whole balance sheet and takes us out, or the company does an equity raise or sale of company, or maybe some combination of those things. And so we try to structure our loans based on the likelihood of one or more of those three things happening. And we're very customized in terms of how we do that with the borrower.
How do you think about rates? So somebody comes to you, you have to assess their worthiness, obviously. How do you create rates, and how do you kind of think about rates in general?
Yeah, so that's a great conversation. We need maybe several hours to tackle that one in full. But I guess what I would say at a high level is, we believe in really a risk-adjusted return, based on each customer being different. So we don't have like a pricing matrix or grid where it's formulaic. We really look at each deal on its own and consider, what does our cash flow repayment look like? What's the collateral to support it? Are there guarantors as part of this? And that really kind of goes into our pricing. I do get the question a lot around, well, when rates are going up and down, how does that impact you? And given where we are today, it seems like rates are going to fall. Does that impact you? And, I would say that the economic conditions around us impact our pricing decision only in a very minuscule way, meaning our pricing is really set based on supply and demand. And, as I've kind of shared, we're in really high demand and we have kind of our own limited supply. And that really kind of dictates our pricing. So, I don't get overly concerned about, are we in a rising rate environment or falling rate? And given the fact that we stay pretty short, meaning, under 2 years, we don't have a lot of interest rate risk sensitivity. So that, it's all kind of,
Yeah.
that's part of, there's, again, that art and science that go into how we price and structure our loans. But at the end of the day, I feel like, we're significantly more expensive than a traditional lender. But if you're the borrower, what are your options? If you're looking to, hey, we want to, let's say, add more clients or get into a new market or take on a new product and we need working capital to do that, or we want to buy a competitor, what are your choices? First of all, you could be using the recurring cash flow from the business and reinvest in the business, which frankly most entrepreneurs are already doing, or you could sell equity, which is much more expensive than us, in my opinion, and it's dilutive. So you're giving up, some degree of control, or you can take on debt. And if you've already maybe maxed out your bank, or your bank is kind of at their limit with you, then where do you go? And that's kind of where we fit in. And we do want to be fair, but in reality, I think most of our borrowers are less concerned about interest rates and more so concerned about the reliability of access to capital. And that's kind of what we focus on.
Yeah, absolutely. In terms of, what do the rates typically look like for these type of companies? Are you talking like, 10, 15%? How does the spread kind of compare to, treasuries, for example?
Sure. So first of all, we're typically interest only on our structures, all the way with interest due, payments due monthly, all the way through, and then a balloon at maturity. So that's generally how we form our loans. Um, we do expect coupon yields in kind of the 15 to 17%, and we do usually have 1 to 3 points of origination, and usually there's an exit fee as well. Sometimes we offer a pay in kind feature, and we can be again creative around how we get repaid. So that's generally our starting point, but every customer, like I said, is unique, and we don't have a set kind of product. We just build it around them. Now, what we don't do, I just kind of add in there, is we're not really there to be kind of a dedicated asset-based lender. There's plenty of other lenders who do that. We're not a real estate lender, we're not doing that. So, we're kind of opportunistic, which implies that there's creativity around how we structure our loans.
That makes sense. Just curious. I mean, obviously you have your niche, right, and where you guys focus on. Is there any specific trends you're seeing in the types of businesses or sectors that you maybe like more than others that are coming your way more so than others? I'm just curious.
Yeah. So, I guess in terms of trends, I do get that question really more from our investors than borrowers around kind of what's going on in the world around us. And, you know, I've seen really good loans get made in the very worst of times, and I've conversely seen really bad loans get made in the very best of times. So, my point of saying that is small business is very resilient, you know,
Yeah.
for the most part, and there's plenty of businesses out there that are doing just fine. And again, the businesses we talk to from a revenue standpoint, kind of gross revenue, are typically under 75 million. I call that small business or more of kind of emerging middle market. So that's kind of the segment that we're talking about. I can't really speak to, the larger segment, but at the size that we talk to, um, nothing's ever perfect, but there's plenty of businesses who are doing fine. And, COVID was, again, a really good example of the entrepreneurial spirit and the willingness to kind of pivot a business model. And I saw lots of businesses figure out, okay, we're not going to change our product, but how we deliver it's got to change. And, I see that even, now 3+ years later.
Yeah. Great point. Obviously, it changed both for them and for you, right? Obviously, you can't meet with them for a certain amount of time. You're used to meeting in person. They kind of kick the tires a bit,
Yeah, I
but
mean,
it changed a little.
yeah, I mean, I stay at the end of the day, we're still a very face-to-face business, but just like this
Yes.
conversation we're having, face-to-face might mean different things than it did,
Right.
even a handful of years ago.
Yeah. Absolutely. What are just curious? Any misconceptions or maybe questions you always get asked by borrowers or your potential customers that you kind of see on an ongoing basis?
Sure. I mean, we do get considered, we do get asked, hey, are you a hard money lender? And I have no problem, I have no ill will around hard money lenders. I just kind of characterize that category as lending into troubled situations and trying to heal them. And that's not, again, not what we do.
Could you
I
could you define the
also,
the hard money lending real quick?
well, I mean, that's kind of it. It's a company that is probably not cash flow positive. There's a negative event that they're navigating through, and they need help to survive. And I think the lenders who do that kind of business lean more into their primary source of repayment being liquidation of collateral than it would be cash flow from the operations of the business, which is what we focus on. Collateral is
Right.
important, but it's secondary to having sufficient cash flow, which is why the businesses we work with, have already kind of proven themselves to the public. The public has said, yes, we like this, it's a profitable, cash flow positive business, and that's kind of our starting point. Now, I would just kind of, this is a little bit of a tangent, but share with you part of our ability to be creative is we've had a couple of businesses come to us where the underlying business was not yet cash flow positive. But, it's entrepreneurs who had a good vision, and frankly, they had outside sources of cash flow that were totally independent from the business. And so and that might include, W-2 income from spouses kind of thing. And so we're willing to look at things much more globally and consider things beyond just the underlying business. And that's, part of what's fun about what we do is, everything's unique. We customize everything. And so we're willing again to kind of listen to that story and think a little bit outside the box, or maybe just have a bigger box.
There you go. Yeah. Very much a holistic approach that you said, right? Kind of
Yep.
looking at everything taking that into consideration, not just the current state of the business, but the founders, kind of where things are at. That makes sense.
Yeah.
Yeah, I want to get to the investor side in just a minute, but to kind of wrap up some things here on the borrower side, what are some of the risks in terms of obviously loaning somebody capital? What are some of the risks on your end that you and your team are thinking about?
Sure. Well, I mean, hey, are we going to get repaid? That's the risk of, lending in general. I feel like I say that a little bit jokingly, but there's many things that keep me up at night, but that's certainly the number one thing on the borrower side is, are we going to get repaid? But I feel like we're very diligent about our underwriting, which frankly we continue even after we close a loan. So we're getting financial reporting typically monthly from all of our borrowers. I actually do look at it. I have conversations with the borrowers. We don't just file it away or kind of forget to ask about it. So that is really important to us. So we stay really close to the borrowers all the way through until maturity of the loan. And then beyond that, I feel like we're well structured from a collateral standpoint. We're taking a UCC filing on all business assets, which might cover the entire loan or part of it. Um, we're taking personal guarantees in almost all cases, and then we might seek outside collateral, a second on a piece of real estate. We've taken filings against purchase orders, or really anything that we need to kind of shore up any risk in the loan. So that's part of it. But there's always risks that come to us that we don't think about. And COVID is, again, to kind of come back to this, is the perfect example. We weren't underwriting loans thinking about a pandemic 4 years ago. But it happened, and we pivot and figure it out. And staying really close to your borrower is the number one way to do that. And communication is really important, not just until you close a loan, but all the way until maturity of the loan.
Yeah, and that's a great point. When you guys get these financial statements, are you making sure these statements are audited? Like if I took a loan from you, you're not just taking my word for it, when I send you these statements, or how do you think about
Yeah, I
those?
mean, that's a great question. So that again, that's part of the overall risk assessment and how we price our loans. I would say that at the size of companies we're working with, we're typically not getting audited financials. I mean, that's going to be a much larger company typically. Our information could be coming from as a CPA prepared financial statement or reviewed. In other cases, we're doing a combination of company prepared returns and tax returns. And again, that's just part of the analysis. It's not the entire analysis, but that is a consideration, is the quality of financial reporting and the accuracy. I mean, we don't have it with any of our borrowers right now, thankfully, but I've seen potential borrowers come to us where their balance sheet didn't balance. And, that's kind of a red flag for sure. And, that's part of, what we look at in terms of the risk profile.
That makes sense. And obviously, you mentioned it's not just a one and done. This is ongoing. You're getting statements every month. You're checking in with your borrowers, so that's obviously crucial, and that mitigates obviously
Yeah.
from a risk perspective
Yeah, I
what's
mean, we
happening.
take a lot of pride in the fact that, I know every one of our borrowers. So it's not like we have thousands of loans in our portfolio. I know every single one of them. I interact with all of our borrowers in a conversational way at least once a quarter. We're getting financials monthly. Those who are doing really well, there's not, maybe as much to talk about. But, I think our borrowers lean into us not just as their lender, but it's kind of that's within that circle of trusted advisors. And we take that role really seriously. And to the extent we can offer value in other ways, just referring them to maybe hey, I need a new CFO. Who should we talk to? Or hey, we're looking for insurance. Who should we talk to? We're always happy to help in those ways too.
Yeah, that's cool to think about. That's something I never really have considered with credit funds. So it's interesting to hear that perspective. Talk to us about some of the bad deals, like some nightmare scenarios. What are some of the worst deals that you've come across? How have you kind of dealt with them, and what does it look like? I mean, I'm sure you have to talk to creditors or people that are trying to liquidate these companies. What are some of the bad deals, and kind of how does
Yeah.
that look like?
Well, so fortunately, I can say that within our portfolio today, we've really not had those kinds of issues. So we've had a few past due issues, but we stay close to them. I'm not concerned about the credit quality within our portfolio. But hey, I spent 25 plus years in lending. I've seen some bad stuff out there. Um, I work with borrowers who maybe bought a business, but the seller didn't really go away and then kind of crowbarred themselves back in. Or we got financial statements that ended up not being accurate. And, for better or for worse, spent some time in special assets management, which is kind of the bad boy, section of banking, and saw, that there's, many entrepreneurs who have their heart in the right place, but there's others who, kind of treat their bank or their lender like a vendor. And we're not here to be a vendor. We're here to be a partner. And if you want just a vendor relationship, which is kind of like we want the low cost provider, that's not what we do. But, especially as the size, and it's not just banking, but as the size of company you're working with gets bigger, it becomes more of a commodity or vendor discussion and less a relationship one. And, that's again why I kind of learned some lessons from being in a big bank for a number of years and why I enjoy, really being part of a small business now.
I want to turn the tables and start talking about the investor side of the business. So let's start with just like capital raising. So how do you go about raising capital for, a fund structure?
Yeah. So maybe I'll back up and share just a little of kind of overview. What is our fund, and then get more to your question. So we're not a bank. We don't take in deposits, which is how banks then turn around and lend money. So we created a fund is our mechanism to go out and make the loans. So our fund is what's called an evergreen or open-ended fund. We don't ever have a close date. This will go on in perpetuity. And the reason why is as loans pay off, we just recycle the dollars and make a new loan. And so we would likely never stop doing that unless we couldn't find good loans to make. And that's not been an issue for us so far. So our fund is really structured as an income style strategy. So we're not, first of all, a growth fund. We're never going to have outsized returns. We're not making equity investments in these businesses. We're a debt provider, and we want to be, consistent, although we have a range of pricing certainly within that. So, we're all about capital preservation and then a recurring income stream, which we do via a quarterly distribution. So we have a target return to our investors annually of 10%. We pay a distribution every quarter. We're really proud to say that we've beaten that return every quarter since inception of the fund. And this has proven to be good for those who are looking for a little extra yield, and maybe they have um, liquidity they're not sure what to do with, or they have other fixed income instruments that they're maybe looking to complement with something with, in my opinion, a modest degree of credit risk, or they maybe have a concentration in real estate or a business and they're looking to kind of divest from that. So the capital raising side, this is definitely a significant part of my time. Finding loans for us is really easy. I mean, borrowers find us. We don't have to, market much for that or really at all. So, supply is not a problem. And the irony is not lost on me that our borrowers are coming to us because they're capital restrained in most cases. Well, so are we to some degree too. So I'm proud of the fact that our fund has about $15 million of assets under management in it today. We have, I think, 47 limited partners in the fund. It's been mostly individuals and families to date. We're trying to move a little bit, broaden that, but move up market a little bit too to more smaller family offices. The RIA community is, I think, an important source of capital for us. But I spend a lot of time on the capital raising side. So, I'm networking with those who manage money for others who would have an interest for something like this. And those are kind of one conversation at a time. And I feel like we have a very compelling product. But like any kind of emerging manager or new fund, we get the feedback of this kind of concept of too small, too new, a lot. And I have a really thick skin about it. There's nothing I can do about it other than every quarter that goes by, we're less small, less new. We have a consistent return, and that we stick with kind of the objective data, in telling our story.
Yeah, yeah, definitely. It's tough sometimes. Nobody wants to be the majority stakeholder. They have a minimum ticket size of 5 million or 10 million, whatever it is, right?
Yeah.
But at the same time, though, I'm curious, just from an investor feedback perspective, just the questions you get asked on their side probably comes down to a lot of things. One being the qualitative and quantitative process of due diligence,
Mhm.
all those things that you go through, right? Which you've done for years. So I'm curious, kind of. hear kind of the feedback that you've gotten to this point.
Yeah, I mean, the number one question we get is, what could go wrong? Which is,
Yeah.
I mean, I guess what could go wrong is all of our loans could stop paying. We go into default, we can't collect, and the fund, ends. Now, I think that's a extreme, view, and I don't believe that that will happen. But I have to think about that, and there's no guarantee in this. And our return is only a target. There's no, guarantee of this. And so, that's for an investor, they have to consider that. And so when I think about, well, what are their alternatives? So first of all, we do have a 2-year commitment on our fund. So if you put money in, you got to be in there for at least 2 years. Although we do pay a distribution that can be paid in cash or reinvested, it's up to the investor. The reason that we have that is because the average duration of our loans are 18 months. So we're not highly liquid from that standpoint. So, from an investor perspective, what else could they do over a 2-year time horizon to generate a similar type of return? So, the easiest comparison would be like a 2-year treasury or 2-year bank CD. I think today a 2-year treasury is around 440. Well, 2 years ago it was probably 140. So, if that's kind of the range, the choice of the investor is, well, I could do something at essentially no risk for 4-ish%, or I could put money in a private credit fund that has, in my opinion, modest degree of credit risk, but the return is 10 plus percent. And last year, kind of in total, we were about 11. So I'm super proud of that. And so is, the 600 or 700 basis points of difference, is it worth it? In my opinion, it is, but I'm not a financial advisor. Um, but that's kind of the decision I think our investors are thinking about. And I guess the other thing that I would throw maybe on top of that is, part of the decision making is this idea of supporting the small business community. So we absolutely have investors who are former or current entrepreneurs who have kind of navigated through the challenges of starting a business, obtaining credit, challenges with credit, and then ultimately having a liquidity event. And I think there is a growing segment of our investors who really take pride in the fact that they've kind of navigated through that storm. They had a positive outcome, and their dollars they're investing, at least in part, are going to really support exactly that same kind of community. And that's never a guarantee and doesn't translate objectively into a return. But I think people take pride in it, and we're super proud to support that community.
Yeah, absolutely. Yeah, it's small businesses. It's the heart of America. So I love to see that. You mentioned evergreen structure, so I like to think about that. Kind of how you structure that. So with in terms of these loans coming in, how do the investor redemptions look?
hmm So, I mean, first of all, we have a 2-year commitment, like I said. So there's no redemption of principal allowed in those first 2 years. After that, they can request it quarterly. However, I would say, first of all, what I would add to that is, just like our borrowers, we screen and interview our investors too. And if someone wants to be out in 2 years, probably I'm going to say this is not a good fit. I mean, if we're not delivering on our return, then yeah, I get it. But if we are, we want to be a longer term partner than just, that period of time. However, we do pay a distribution, like I said, quarterly. It can get paid in cash, which probably about a third of our investors do, or it can be just reinvested to their capital account, which is, 2/3 of our investors are doing that. It provides, some degree of compounding effect. And, you know, I'd say that by and large, most of our investors want the yield and that kind of return, but don't necessarily need the cash in pocket. And, from an evergreen structure, we kind of did that. With a lot of intention because we would like to continue to grow our fund. We see a lot of opportunity out there. We'd like to take advantage of market conditions and help more borrowers, frankly. And so having a fund that is constantly recycling is really part of that. And like I said, we would only stop raising money if we felt like we couldn't find good investments in the form of loans to make. And that's not an issue, and I don't foresee that it being one anytime soon.
Yeah, yeah, definitely. I do see a lot of evergreen funds just launching in general, given that efficiency play, right, of
Mhm.
just recycling new opportunities and not having to close down one structure, create another fund two, if you will, and then spin that up again. So I definitely can look
Yeah,
at that as
and
kind of
you
moving
know
to
what
that
I
model.
see too, because you talked about efficiency, is it's hard to do small things efficiently, and I understand why other private funds have maybe grown up over time, or they just focus on larger loans. I mean, doing a $10 million loan or $1 million loan takes probably the same amount of work, um, but there's efficiencies as you get bigger. But we are a very lean, scrappy organization. We keep our overhead very low. And so we can do small loans, which are frankly the kinds of ones I like better anyway. We can do them really efficiently. And so that's why, our segment of the marketplace is a little bit less crowded. But, I love it. And that's why we'll continue to stick with it.
What do you think about in terms of capacity? So if, $1 billion came in today as an example, would you be able to put all this to work? How do you kind of think about
Yeah.
capacity and maybe
Uh,
even capacity over time as you scale?
yeah. So do you know someone who's thinking about it?
Maybe.
Yeah, I mean,
Mike,
I do get that question a lot. So I'll answer that maybe two different ways. So first of all, kind of what are our goals? So we really feel like we can efficiently manage the segment we're in with a fund in kind of that 30 to $50 million range. So we're aggressively trying to get to that size. We feel like we don't need to add people resources up until we're at that size or larger. So that's kind of why we're trying to fill in the capacity that we already have in place right now. I also feel like, given our average loan size, that the level of credit risk diversification at a fund, 30 to $50 million, I just feel better about. I mean, you're just putting your eggs in more baskets, basically at that size. So, as I think about investors who come in, our average investor today has about 350,000 with us. We're super proud and happy. I'm very grateful for everyone who, has entrusted their money with us. Um, and we'd like to continue to grow that, both in number and kind of average size, so that we can do more loans. From a investor standpoint, we would like to continue to kind of move up market. And So that's why we've made investments in technology to help us work kind of with the RIA community and more foundations and smaller family offices. And, to kind of then answer your question, if someone, first of all, we have a big backlog of loans. So if someone wants to invest our minimum 100,000 or even a million, we could deploy that right away. So I would, advise them, just write us a check because it will go out the door as soon as it comes in. 5 million, I would say yes, we would love to, work with you. It would take us maybe 30 days to deploy that. 10 million, then I would maybe say, why don't we do a kind of a capital call situation, and we'll take half of it now, and then, probably in 45 days we're going to want the rest because we have, the backlog that we're always facing. Having said all that, I would just caveat by saying, our investors, when they join us, their dollars go into the fund as it exists, at that point in time. So you're not waiting for a new loan to be made. You're in the whole portfolio as it comes in. And we stay, very deployed of our assets under management in loans at all times. So we don't sit on cash, which is why, we can provide the return that we do, again, given our loan demand, and why, as dollars come in, unless it's that $1 billion investor, we'd figure it out. But, the smaller ones that we work with, we can deploy that, efficiently and very quickly.
Yeah, that makes a lot of sense because that's actually what I was going to go into in terms of like holding cash. It sounds like you're able to deploy right away with, I guess, kind of the backlog in terms of loans. Are you, do you like, you kind of mentioned, $5 million comes in, you're able to deploy that, pretty quickly. Uh, in terms of like, when you're doing the due diligence on these companies, how long does it take? And, do you have like,
Sure.
do you have those people ready? Like, hey, next $1 million, coming your way.
Yeah, absolutely. So we have borrowers that we're working with today where we have underwritten the loan, we've documented the loan, we're ready to sign, but we're waiting for additional capital, which, for us either comes in from investor activity or an existing loan paying down or paying off. You know, lending is much more predictable to understand when we're going to get liquidity. The investor side is harder. So we have borrowers who meet that, are in that criteria. We're very sensitive to um, kind of timing issues. So if a borrower's, has a drop dead date to buy another business or complete something, and we don't feel like we're going to have the liquidity, I mean, we're super upfront about that. So our borrowers, are pretty patient for the most part. Sometimes we'll break our loans into multiple advances. So we don't do revolving debt, but a $2 million loan, we might do a $500,000 advance for monthly for 4 months, kind of thing, to kind of make that work, and just to get in as many as we can. So we do think about that. From an underwriting perspective, we have the ability to move very quickly. We did one loan in fourth quarter of last year where I think from inception of conversation with the borrower to when we funded the loan was, I think, 5 business days. Now that's, we had the liquidity. It was kind of opportunistic. We've since gotten repaid on that loan. It worked out great for everyone. So being nimble is certainly something we take a lot of pride in. We'd love to be able to do that more often, and just kind of the timing worked out in that transaction. In reality, most of our loans were probably from initial conversation to when we're documenting a loan, it's anywhere from a 2 to 4 week process, which I think is still, compared to traditional banks, is still pretty good. Again, it's kind of the timing of the liquidity that's a bigger challenge for us than being able to underwrite the loan.
Yeah. What are your thoughts on? I know I talked to a lot of fund managers as well. I'm just curious your thoughts on. We talked about earlier how some investors that are larger asset owners, right, that can't invest in your fund from the minimum
Mhm.
constraints. They have a certain minimum themselves that's higher than that. I know some managers have taken the approach of like, let's do a side, almost like a managed account situation, or they'll create the structure and then it'll be a separate, fund in itself that you'll deploy because they like you, they like your due diligence process, they like what you brought to the table. Have you guys thought about that at all, or is that something that's
Yeah.
separate conversation?
So, I'm an opportunistic guy. I'm willing to talk to anyone, in a way that if it makes sense, we would certainly look at it. We do have the ability to do sidecar letters within our fund. We haven't to date. We really try hard to keep things really simple. I think that benefits everyone
Sure.
when we do that. But, we see loan demand out there. We'd like to be able to say yes more often. So we're willing to look at these kinds of things. I had a conversation with a small family foundation the other day that said, we really like what you do, but we have a minimum check of 10 million and we can't be more than 10% of your fund. Well,
Right.
we're a $15 million fund. 10% of that's $1.5 million. We'd love for them to be $1.5 million, but it's below their minimum, and it's kind of that chicken and egg phenomenon. But, at the end of the day, I have a very thick skin about this. My feelings are not hurt. We continue to grow. We're adding investors every month as is. Um, but, I do see the opportunities out there, and we would like to go, a little bit more up market, as we've talked about. So we're willing to look and talk to anyone around something that would benefit everyone. But, I do believe very strongly in being very fair to all of our investors. And so I'm not going to, do something that would jeopardize that just so we can make more loans.
100%. Yeah, it sounds like the loan, you have a lot of opportunity on the loan side.
Yeah,
Just trying to find the right opportunity for you guys, which is great, right? That's important.
absolutely.
What are your thoughts in the macro space in terms
Well,
of
I
like
mean,
macro private credit?
yeah.
What
Yeah,
are you seeing out there?
so, first of all, we're the tiniest of pebbles in a big and growing ocean, and I get that. And, frankly, I'm fine with that because, we roll out the red carpet for our borrowers and our investors, and everyone is a big fish in our small pond. And that's the way we like it. We're always going to try to operate that way. And I think people appreciate that, and that's kind of who we tend to attract. Private credit, I think today is like a $1.5 trillion industry. I can't remember what that was, maybe even 5 years ago, but I suspect it's probably doubled in that period of time. And I see, just kind of based on what we talked about earlier around big banks being conservative, kind of growing credit need, I think that will only continue. Especially it seems like at the larger end of that curve, meaning loans, let's say 10 million and up. And again, there's efficiency issues with doing small loans, as we've talked about. but there's no less of a need in it.
Any final thoughts for either investors looking to get into, a credit fund or, borrowers looking to borrow money from a credit fund?
Yeah. Well, first of all, we're happy to talk to either. I mean, I love talking to borrowers. We get referrals sometimes where the person making the referral is saying, "Hey, I don't know if they're going to qualify or not." And my response is, "Don't worry about it. I've been doing this for a long time. Things kind of come full circle in life. If I can provide value, great. If I can't do the loan, I probably know someone who can." And so I'm happy to talk to anyone. On the investor side, we're definitely looking to continue to add investors for the reasons we've talked about. Demand is there, and we feel like we have a good product. Um, and I would maybe close by saying I love what I do. I mean, lending is all I've ever done. My golf game sucks. I've never won the Powerball. I'm not going to. So this is what I do, and I enjoy helping see businesses leverage additional capital to success. And I'm going to keep doing it, and I have a very supportive group around me that allows us to do that successfully and efficiently, and we're going to keep going.
That's great. Well, Jamie, really appreciate it. This has been a lot of fun. Learned a lot talking with you. Where could people go
Likewise.
to connect with you and learn more about your company?
Sure. So we're again Meriwether Group Capital. We have a robust website. We're on LinkedIn. I'm on LinkedIn. You can reach out anytime. We have all of our email on those resources, and happy to start up a discussion.
Amazing. We really appreciate it, Jamie. Thanks for being on the show, and we'll make sure to include that in the notes.
Thank you very much. It's been a good time.